Hello, everyone, and welcome to another episode of Financial Markets with 4C Markets. My name is Alejandro Ramirez Linus. I am your person who brings you the things we find when we're writing out algorithms. And of course, I have my co-host, Serhii. Want to introduce
Hello,
yourself, Serhii?
everybody. And today we will have really interesting topic. We will talk about different features, what Alejandro is looking at, and how exactly he gets his inspiration. So, Alejandro,
There we go.
you have found some interesting
My
pattern.
inspiration. Yeah,
Yes,
I like how you put that.
Yeah, can you
So,
tell more
okay.
about it?
Yeah. So my inspiration. So what happened is that, of course, inspiration comes from the news, and as we watch the news, we continue to hear about the oil market and the S&P 500, and this too, you hear that are talking about all the time. So start paying attention to this, especially 12 weeks ago when the war started with Iran and they closed the Strait of Hormuz, right? Because all of a sudden there's less oil, which means the oil prices go up. How do you track them? Well, especially, me in particular, I track them with USO. It's a exchange traded fund. And I also track the S&P 500 with SPY, right? So when I started tracking this, I realized that they are indirectly correlated within a 6-hour gap. That means that you can use one, you can specifically use the USO to know what will soon happen when the S&P 500. And we figure we should talk about this on the podcast, right? So we're looking at TradingView here just for today, but this works if you look at it for over the last 12 weeks. And it makes sense. Because what happens is, as you see here, like when we're looking here on the left, there's like a huge spike here on the S&P 500 on the left. That's what this left chart represents. And here on the right chart, we see that there's a drop. So when we analyze this, we started to realize that the USO drops would happen first. So whenever we were looking at a particular chart, we started to see that, for example, this here that I'm drawing a box on was actually happening before this box here that I'm going to draw a box on now, right? So we started to notice that when one was going up, the other one started to go down. And I was like, okay, is this correlated or is it just one-off? Turns out that it's been happening like this over the past 12 weeks continuously. And the best predictor you have is a 6-hour lag. And so this kind of makes sense, right? Because when you think about it, price of oil goes up. So now everyone has to scramble and figure out what are they going to do with their oil futures. Are they going to go and sell oil? Are they going to try to buy oil before the price continues to go up, etc.? That means that money will be taken out from one system and put into another system, right? If you think about money as something that recycles itself, right? That's just the nature of money. Why do I say money recycles? I'll just talk very quickly about that. When you go and you buy a phone and then you hand a certain amount of money through, credit card payment or through cash, that money is going to be used to pay the employee that sold you the phone, right? And then that employee will in turn go and buy something that eventually will get you some money back, right? That's just very circular. So money recycles. We can talk about a whole new episode about how new money is created, but we're not going to get into that right now. Long story short, because the money is being moved from one system to another, it makes sense that when oil prices are going up, money has to be taken out from another system and then put into oil, right? So people are thinking I'm going to need some money for this. I'm going to sell my assets in the S&P 500. And those assets are now bringing in cash and they're utilizing it to buy, USO or things that will eventually cause the USO ETF to go up. So they're going to buy more oil or they're going to sell more oil depending on what they're doing. So what happens is that when that is taking place, you can track it and make decisions on the S&P 500 based on what's happening on USO. So me personally, how do I use this? Well, if I'm looking at a stock that I've already profited from, and I know that the S&P 500 is going to go up, I'm gonna wait until I see that it peaked, right? So now, since I have this marker, if I see that USO is going up, and I'm already trying to sell a stock, which is part of the S&P 500, I'm gonna sell that stock right away. But if I see that USO is going down, then I know that this particular stock has room to grow. So I'm going to use this marker to say, okay, I'm just going to wait before I actually sell it. So I'm going to set a limit instead of trying to get rid of it now. I'm going to set a limit and I'm going to sell it at a later stage, maybe through a call or maybe through a limit, you know? But this is the kind of things that you can do when you figure out this anti-correlation. Now, for me, this is based on my trading experience. But we're gonna get into the mathematics of how this works because I know Serhii has been wanting to talk about this. So I'm just gonna hand the keys to you, Serhii. So if you can please tell us why this works mathematically.
Well, it's actually when I heard about this correlation, let's put it like this, it was for me really interesting to check and see like if it's really so and at which lags and how it works. So basically, like my idea to verify this, because on the graphs I literally see, yes, there is like some dependency. So when the graph goes down, like for SPO, USO, and another like for SPY goes up at some point of time. But there is some moments where actually say one goes down and second goes down, or one goes up and second goes up. And for me, it was literally really interesting to plot, to visualize how exactly, like what is the actual distribution. So how many cases where when you take, for example, one candle, which like goes either up or down, so you have like a downward let's say situation or upward situation. So how many cases across all the, let's say, last 12 weeks where we see this pattern were given us this like asymmetry. And actually, if you can see my screen, can you see my screen?
Yeah.
Alejandro?
Yeah.
Yeah, so these are the distributions. So what have I done? I have looked through the 1 hour candles of USO for 12 weeks back from now. And I broke them into buckets. So B0, it's like zero bucket, like B1, it's the first bucket, and so on and so forth. So we have in general 10 buckets. And I've been looking for different hour lags. So if we are at the present moment looking 2 hours back and looking at the candle of USO 2 hours back, if it was, for example, in bucket 0, which is like from minus 12.17% to minus 11%. And if we are in this bucket, so we literally start calculating ROIs, number of ROIs, if they're positive or they're negative. And
So where did you find the best lag? Like, what is the best predictor? How many hours do you have from the time that you detect this
so
until you
the
should
first
exit?
part, like what is really interesting, so there's a lot of interesting like histograms and distributions.
Yeah.
And I wanted to visualize it literally a bit different way, like to see what is actually you're asking. So basically the color shows here like the total gain. So for example, let's look at this quadrant. So it's bucket
Yeah.
number 2 from for all candles that ended with within the diapason from minus 0.62% to minus 0.32%. So if you see this
And what's the lag on this? Like from the time the USO changed direction,
yeah, like
how
24
much
hours.
time?
So this exact
So
coin is
it's a
24 hours.
1 day.
Yeah. So you
So
literally
this is
trade within
basically you buy
24
today.
hours. There was like for the last 12 weeks, 40 entries for all of this. And each and every single entry would have done us like 1.2%, which on average, on total, will give us for just one, this indicator, 49.6% of gain. And the
So
accuracy
okay,
is
so
85.
let me break that down into plain English because this is what's really exciting, right? This basically means that if you're looking at USO and you see that it's shifting directions, you have a 24-hour window where you need to put your money in the right direction, right? Because direction is important in this case, like we're talking about vectors. So if USO is going down, you can put your money on the SPY ETF, for example, if you want to, and then let it ride until it goes back up, like until USO goes back up, and that's when SPY will go back down. But the change is not immediate, which is what's astonishing, right? You actually have enough time to determine when to enter and when to exit. And I think you mentioned something like you have to do this within like it's only good for 24 hours from the time you enter, right? And then you have to be able to match this.
Basically, each bucket is like 1 hour you enter, and then within 1 hour you exit. So also interesting buckets around is the same buckets too, from zero like minus 62 to minus 0.32% range. And if you look at 12 hours before, so you will be like having again 40 trades, but you will be making like 30% from this. So if you were looking only at this bucket, only at the candles that triggered within this range, and you were trading
Mhm.
only these two, so in total you would make like 30% profit plus 49% profit. So it will be like quite a lot, right?
So okay, so I'm just gonna say it in plain English.
79%
Basically,
profit.
keep an eye on USO, right? That's the stock that we're basically discussing here. So I'm gonna share my screen just to like say it in plain English. So basically, this stock here, this one USO, if you see that the price of USO, this one, right? If you see that the price of USO, United States Oil Fund, is going up or is going down, you have time to enter into a position in the S&P 500, such as like NVIDIA, for example. That's a very well-known stock, or Amazon, that's another one, or Google, or just, SPY, like just buy the whole S&P 500 and let it ride. You have time. So that's basically what we found with this. If you don't believe us, give it a try, right? Like buy one stock, you're only gonna be using what, $700 maybe. So if you have $700 to spare, just wait until you see that USO starts to go down and use that to buy the stocks for SPY. Or when USO is going up, buy SPY. And then when you see that USO is going down, sell SPY. That's where you will be able to make your profit. This is what we discovered. And we discovered that it happens within a 6-hour time shift. So from the time that USO starts to go down, you have about 6 hours to make your purchase before it changes directions, or before the direction makes no difference at all. And this is what we discovered. This is something that is really interesting. We've been looking at this for a little bit of time, and we tried to put some math behind it to figure out if we were crazy. And turns out that yes, we are crazy, but in this case, we were also right.
I think Alejandro and the audience will also have a question like, how much time do you think this pattern will stay there? Because for people who will
Ah,
be watching in a year or 10 years, I doubt it will be
right.
this pattern there.
So this pattern started 12 weeks ago when USO started to skyrocket. So I would imagine this is only going to last as long as there is a war. As long as we continue our war, we're going to continue to see patterns like this pop up. And this is just one that we discovered. I'm sure that there's going to be plenty of them. What we need to make sure that we do is we need to try to make sure that we pay attention. Like, if you notice here, USO started to go down in price, right? It's down to 141 from its peak of 143, right? Down to 141. But the S&P 500 is actually going up, right? This is just a 24-hour window. So this is what we need to pay attention to, that once the war is over, this will no longer work, because if you notice USO on 5 years, you will see that it's been actually very, very, very stable the entire time over the 5-year period. There's like literally been very, very little movement over 5 years, and then all of a sudden when we start the war, it just like skyrockets. Right? That's what you see here, like this little blimp. When you zoom out and off, you can barely see it, but the rest of the time it's just there, right? It's just flat. And then now it's $141, where before it was, down to like $60, I think, $47 a share. So this started when the war started, and it will probably end when the war ends. So we just need to make sure that if you're gonna use this particular strategy, you don't use it for a very prolonged time, because then it's not going to work for you. Then you're going to end up, just keeping your money in the market after this strategy is no longer working.
But at the same time, this is
And
pretty
yeah.
interesting idea for how can the strategy be built. Just looking at
Oh
this
yeah.
kind of patterns.
Yeah, exactly. And that's what's important. That's why I wanted to like zoom back in again. And I'm sure there's like better ways to use TradingView than my, clicking around and showing things. I'm usually working with raw numbers. So when it comes to showing, it's just a bit different. So yeah, that's basically what I wanted to show today. This is our finding that we wanted to bring to our audience. That's everything we have for today.
Great. Subscribe, share, like, comment, and see you on the next episode.
Yeah, please do go ahead. If you like our episodes, go ahead and subscribe and share and press the like button. And we will see you all next week. Let's see if we find something interesting to show next week. Maybe a new pattern will show up, you never know.
Absolutely.